Economic crises. They sound like boring textbook stuff, but when they happen, they shape lives, destroy fortunes, topple governments, and sometimes even spark revolutions. In just a few minutes, let's race through the major economic crises that have rattled the world and see how they unfolded. Spoiler, history repeats itself more often than we'd like to admit. Let's rewind way back. Ancient Rome. Believe it or not, they had their own financial meltdowns. Around the 3rd century, Roman emperors kept devaluing their currency by mixing more cheap metals into silver coins. At first, nobody cared, but as the coins got worse, people realized, wait, this isn't worth anything. Inflation exploded, trade collapsed, and the empire weakened. You could say Rome was one of the first examples of what happens when a government thinks it can print money forever. Fast forward to the Middle Ages. Europe had a crisis of its own after the Black Death wiped out nearly half the population. Less workers meant wages went up, but lords and kings hated that idea. Laws were passed to freeze wages, rebellions erupted, and for decades the continent was stuck in social and economic turmoil. Sometimes, a crisis doesn't even need a bank, it just needs a plague. Then came the 17th century, and with it one of the weirdest bubbles in history. Tulip mania in the Netherlands. People literally sold their houses to buy tulip bulbs because the price kept going up and up. A single bulb could cost as much as a mansion. Then, in 1637, prices collapsed overnight, leaving fortunes destroyed. It was a perfect early example of what happens when speculation goes too far. People didn't learn, of course, because humans never do. Jump to the 18th century. The South Sea bubble in Britain was another speculative disaster. The South Sea Company promised investors untold riches from trade with South America. Investors rushed in. Even famous figures like Isaac Newton bought stock. Prices soared, then crashed in 1720. Newton later said, "I can calculate the movement of the stars, but not the madness of men." And he was right. The 19th century brought industrialization, and with it the first real global financial panics. The Panic of 1825 began when British banks overinvested in risky South American bonds. Suddenly, confidence collapsed, banks failed, and thousands were ruined. Panics followed like clockwork: 1837 in the United States, 1857, 1873, the so-called Long Depression that lasted decades. Each time the pattern was similar: too much speculation, too much debt, and eventually reality hit. But nothing compared to 1929, the Great Depression. The Roaring '20s had been one big party. Stocks soared, people borrowed money to buy more stocks, and everyone thought the good times would last forever. Then the crash came. Black Tuesday wiped out billions, banks collapsed, and unemployment skyrocketed. Soup lines stretched around city blocks. Governments scrambled to respond, and new ideas like Franklin Roosevelt's New Deal in the US or Keynesian economics worldwide reshaped policy forever. The Great Depression wasn't just an economic crisis, it was the crisis that defined the 20th century. And just when things seemed to recover, another disaster struck. World War II left much of the planet in ruins, but it also pushed nations to rethink money itself. The Bretton Woods system tied currencies to the US dollar and the dollar to gold. For a while, it seemed stable, but by the 1970s, inflation, oil shocks, and rising debts blew the system apart. In 1971, Richard Nixon ended the gold standard, and suddenly, money was just money, floating, untethered, based only on trust. That trust has been tested ever since. Speaking of the 1970s, oil. In 1973, the OPEC oil embargo sent energy prices through the roof. Gas lines stretched for miles, inflation surged, and economies spiraled into stagflation, a nasty mix of stagnant growth and rising prices that economists thought was impossible. It wasn't. People learned the hard way that resources, especially energy, could trigger crises just as fast as banks. The 1980s brought the Latin American debt crisis. Many countries had borrowed heavily from Western banks, encouraged by cheap credit. But when interest rates rose and growth stalled, they couldn't pay. Nations from Mexico to Brazil defaulted. sparking a lost decade of poverty and austerity. The lesson? Global finance doesn't forgive, and debt has a way of coming back to haunt you. Then came the 1990s and a new type of crisis, emerging markets in flames. Mexico's peso collapsed in 1994. Asia followed in 1997. Thailand's currency imploded, panic spread to Indonesia, South Korea, Malaysia, and beyond. Millions lost jobs. Entire economies shrank overnight. The International Monetary Fund stepped in with bailouts, but at the cost of harsh reforms. Russia followed in 1998, defaulting on its debt and nearly collapsing its financial system. For the first time, crises were spreading faster than ever, thanks to globalized capital. The early 2000s had its own bubble, the dot-com boom. Investors poured money into anything with a .com at the end, thinking the internet would make everyone rich. And yes, it did, eventually. But in 2000, the bubble burst, wiping out trillions in value. Amazon lost 90% of its stock value, and hundreds of companies disappeared overnight. The internet survived. Investors, not so much. But nothing in modern memory compares to 2008, the global financial crisis. It started with the US housing market. Banks gave out risky loans, bundled them into securities, and sold them worldwide. Everyone thought housing prices could only go up. Spoiler, they didn't. When prices fell, the entire financial system froze. Lehman Brothers collapsed, stock markets crashed, millions lost homes, jobs, and savings. Governments bailed out banks with trillions, sparking outrage and protests from Wall Street to Europe. The aftermath shaped politics for the next decade. And it didn't end there. The Eurozone debt crisis in the 2010s nearly tore apart the European Union. Greece, Spain, Portugal, and others faced crushing debt, mass unemployment, and harsh austerity. Riots filled the streets. The crisis revealed how just fragile even advanced economies could be. More recently, the COVID-19 pandemic in 2020 unleashed another historic shock. Economies shut down overnight, millions were out of work, and governments responded with massive stimulus packages, printing money on a scale never seen before. For a while, it worked, but soon inflation roared back, reminding everyone that money doesn't come free. And that brings us to today. We live in a world of constant uncertainty. Rising interest rates, looming recessions, climate risks, and geopolitical tensions. If history teaches anything, it's that crises aren't rare events, they're baked into the system. Every boom creates its own bust. Every solution creates its own problems. So what's the takeaway? Economic crises aren't accidents. They're part of the cycle, as predictable as tides. Speculation, debt, greed, and shocks, natural or man-made, combine in new ways, but the story is always familiar. From Roman coin debasement to Wall Street crashes, from tulips to tech stocks, from oil shocks to pandemics, the lesson is simple. Humans never learn. We chase growth, we believe the hype, and when the bubble bursts, we're always shocked, again and again. And yet, crises are not only about destruction, they also force change. Out of the Great Depression came social safety nets. Out of the 1970s came new energy policies. Out of 2008 came tighter regulations and a wave of political realignment. Even COVID pushed work, technology, and medicine into new frontiers. Crises hurt, but they also reshape the world. So maybe the real question isn't how do we stop crises, but how do we survive them and maybe come out stronger? Because if history has one iron law, it's this: the next economic crisis is always just around the corner. And now, in 10 minutes, you've traveled from the Roman Empire to Wall Street, from tulips to tech, from breadlines to Bitcoin crashes. Congratulations! You now know more about economic crises than most people who cause them.